It is this heavy, almost suffocating feeling that completely permeates our modern financial culture. You know what I'm talking about, right? That intense sensation of financial FOMO. It's that creeping suspicion that the absolute greatest wealth-building eras have already passed us by, leaving us with nothing but the scraps. Well, today, in this explainer, we are stripping away all the hype to look at exactly what data and history actually tell us about this illusion.
Let's just hold up a mirror to the past for a second. Speak to your parents, or really anyone from a slightly older generation, and you will almost certainly hear some variation of this exact regret. Man, I wish I had bought land 20 years ago. Or maybe, I wish I had bought property back in 2010. For decades, families built their entire financial foundations through real estate, and for those looking back, the regret of not buying more or not buying sooner is this massive, recurring generational sentiment. Looking back, it just feels like a deeply obvious missed opportunity.
Now, fast forward to today, and honestly, that exact same sentiment has simply shape-shifted. Instead of land, the modern investor looks at digital assets and thinks, I wish I had bought Bitcoin at $1,000. Or even right now, millions are looking at the massive explosion of artificial intelligence and thinking they've already missed the boat. The asset itself is completely changed, but that paralyzing feeling of having missed out, it remains perfectly identical.
Which brings us to the central thesis of our explainer today. Are we actually at a historical disadvantage here? Did previous generations really have an easier path to wealth, or are we simply looking at history with the incredible, deceptive benefit of hindsight? Because as we walk through this history together, and keep in mind we're looking purely at the data for educational purposes here, not financial advice, a really fascinating reality comes to light.
Section 1. Decades of passing wealth, the shifting ultimate asset.
If we actually trace the chronological shift of wealth booms, a clear picture emerges. In the 1970s and 80s, gold became a massive wealth creator. People genuinely thought, gold is it, gold is the future, but eventually that momentum slowed down. Moving into the 1990s and early 2000s, real estate became the ultimate dream asset. Everyone believed land would literally never lose value. Until, in many places, growth stalled out. Then came the 2010s, where technology stocks just exploded. I mean, companies like Amazon delivering a near mythical 10,000% rise, and that was soon followed by Bitcoin and digital assets bringing these huge returns. What this timeline historically proves is that opportunities never actually disappear, they just change form.
But here's the catch. After every single boom, people start believing that particular asset will remain the best forever. We have this profound human tendency to mistake a temporary economic trend for a permanent, unbreakable reality. When an asset is skyrocketing, our brains convince us that the trajectory is just infinite, which completely blinds us to the cyclical nature of history.
Section 2. The Hindsight Trap. Chasing Yesterday's Winners.
Think about it. By the time an opportunity is obvious, splashed across headlines, trending all over social media, millions of people already know about it. Investors end up entering near the absolute peak because they look at past performance and essentially they buy confidence. But in doing so, they fall victim to the other side of the coin. They completely ignore future risk, effectively selling their uncertainty. Whether it was the dot-com bubble, the housing booms, or cryptomania, entering at the peak is a psychological flaw where sheer excitement completely overshadows rational risk assessment.
Because history shows us that no single asset remains the winner forever, we absolutely must rely on a defense mechanism. Look, diversification is not exciting at all. But you know what? Neither is wearing a seatbelt. Yet both exist for the exact same reason, to protect you from catastrophic, unpredictable events. Spreading your exposure across stocks, mutual funds, gold, real estate, and cash reserves? It's a stoic, unglamorous necessity against the sheer unpredictability of the market.
Section 3. The Psychology Split. Why Bad Decisions Feel Good. At the core of this, we are fighting an immediate dopamine rush. Overspending, impulse purchases, day trading. These feel incredibly exciting right now. But sound wealth-building techniques, things like investing regularly, sticking to a budget, exercising strict patience, well, they feel incredibly boring by comparison. Good decisions usually feel boring in the present, but they are immensely rewarding in the future. Conversely, bad decisions usually feel highly rewarding in the present, but intensely painful in the future. True financial maturity requires accepting that the actual path to long-term stability is rarely thrilling on a day-to-day basis.
Section 4. Tomorrow's Opportunities. The no-bluff mindset.
If we want to recognize tomorrow's wealth, we have to internalize one stark reality.
the biggest opportunities often look highly uncertain when they first appear. I mean, remember, 40 years ago, almost nobody was discussing internet businesses. 30 years ago, nobody was discussing Bitcoin. 20 years ago, very few were taking AI seriously. True opportunity always starts shrouded in uncertainty and skepticism, never in the safety of a popular consensus.
So how do we practically prepare? Well, we ground our psychological reflections in highly effective, decidedly boring financial vehicles. As outlined in the 50-day finance curriculum, which is targeted at youth who have just started earning, these are the foundational tools that actually build long-term wealth without the hype. We're talking about utilizing mutual funds through systematic investment plans, leveraging ETFs for broad market exposure, contributing to the National Pension System and EPFO, and maintaining dedicated savings and budgeting. These are literally the unsung heroes of wealth creation.
Now, alongside those vehicles, you need a behavioral framework. Preparing for the next wave requires 4 stoic steps. First, stop chasing yesterday's winners. Instead, learn continuously. Second, diversify heavily to protect against the unknown. Third, remain genuinely curious about new, emerging sectors, way before they hit the mainstream headlines. And finally, above all, maintain strict, unwavering patience.
Because the goal here is not to own every single winning asset. Trying to do so is exactly what triggers that paralyzing financial FOMO we talked about earlier. The real goal is to build a stable, educated mindset that can recognize opportunities when they actually appear without being blinded by hype or fear. And again, while this explainer is strictly for educational purposes and not financial advice, this psychological framework applies universally.
History doesn't repeat exactly, but human behavior does. The assets will always change. The technology will always evolve. But the psychological cycles of fear, greed, and the illusion of the missed opportunity, those will happen again and again and again. Recognizing this human behavior within yourself might just be the greatest, most profitable investing lesson of all. Thank you for joining me for this explainer. Keep learning, stay patient, and stay curious.